We are often told that money is just math numbers on a screen, taxes, and compound interest. But if money were purely logical, we'd all be millionaires by simply following a spreadsheet. The truth? Your financial success has almost nothing to do with how smart you are, and almost everything to do with how you behave. Welcome back. Today, we're peeling back the layers of the psychology of money. We aren't looking at investment strategies. We're looking at the hidden biases, the emotional traps, and the silent narratives that dictate your bank balance. Most people think wealth is what you see, the fancy cars, the expensive watches, the vacation photos. But that is just stuff. Wealth is actually what you don't see. It's the money not spent. It's the assets that haven't been purchased yet. Let's start with a hard truth. The get-rich-quick narrative is the biggest enemy of your financial freedom. It relies on the psychological shortcut of survivorship bias, focusing on the one person who won the lottery while ignoring the thousands who lost their savings trying. Why do we fall for this? Because of the lottery effect in our brains. Our ancient ancestors were wired to survive, not to build retirement portfolios. We are hardwired to look for higher-reward, high-risk opportunities to satisfy our immediate needs. To truly master your money, we have to look at the three pillars: ego, fear, and time. Let's start with ego. Ego is the reason we buy things we don't need, with money we don't have, to impress people we don't like. When you focus on wealth, you are building an invisible barrier against the unexpected. When you focus on looking rich, you are building a house of cards that collapses the moment your income stops. The second pillar is fear. The market will always crash. It's not a question of if, but when. The psychological cost of staying invested during a crash is higher than any market drop. During a downturn, your brain tells you to run. It triggers your fight or flight response. But in finance, flight is usually the worst possible decision you can make. Finally, we have time. Compound interest is often called the eighth wonder of the world, but it's actually the most boring concept in existence. It requires nothing from you except patience. But let's address the silent killer of wealth: inflation. If you leave your money sitting in a standard savings account, you aren't saving. You're losing purchasing power every single year. Inflation is a revisible tax on your ambition. To beat inflation, you don't need to be a Wall Street genius. You need to understand the difference between saving, which is putting money away, and investing, which is putting money to work. One protects, the other grows. This brings us to the concept of sufficient. The hardest financial skill is getting the goalpost to stop moving. If you always compare yourself to the person one rung above you on the ladder, you will never be wealthy, no matter how much you earn. There's no point in risking what you have and need for what you don't have and don't need. True wealth is having the freedom to wake up and do what you want, with whom you want, for as long as you want. Let's talk about budgeting. Most people hate the word budget because it feels like a diet. But think of it not as a restriction, but as a roadmap for your priorities. If you don't tell your money where to go, you'll always wonder where it went. A common mistake is the lifestyle creep. Every time you get a raise, your spending rises to meet your new income. You're running faster, but you're still in the exact same place. Break the cycle. When you receive a bonus or a raise, increase your investments first, not your lifestyle. Treat your future self as a bill that must be paid before anyone else gets a cent. We've covered the mindset, but let's look at the math of consistency. The difference between someone who invests $500 a month for 30 years and someone who tries to time the market is staggering. The market rewards patience, not action. The best investors are often those who simply do nothing. They set their strategy, automate their contributions, and go live their lives. So where do you start? First, build an emergency fund. This isn't for a new car. It's for the life events you can't predict. 3 to 6 months of expenses is your financial shock absorber. Once your shock absorber is in place, you need to look at high-interest debts. If you're paying 20% interest on a credit card, no investment in the world will give you a better guaranteed return than paying that debt off immediately. After that, it's time to leverage the power of automation. Humans are notoriously bad at willpower. If you have to decide to save every month, you will eventually fail. If you automate it, success becomes inevitable. Track your net worth, not just your bank account balance. Your net worth is what you own minus what you owe. It's the only scorecard that actually matters over a 10-year horizon. And remember, progress is rarely a straight line. You will have bad years. You will have market corrections. You will have unexpected expenses. The goal isn't to be perfect. The goal is to be better than you were last year. Wealth is the freedom to change your mind. It's the ability to say no to a job you hate, or yes to a project that fulfills you. Money is just the tool that buys you the most expensive commodity of all, your time. Let's summarize the 3 golden rules we discussed today. Rule 1. Wealth is what you don't see. Rule 2. Your behavior is more important than your intellect. Rule 3. Patience is your greatest asset. Don't let your ego dictate your bank account. Take control of your behavior. Automate your savings and start building the life you want, one smart decision at a time. But before you go, let's look at a common trap: the comparison thief. We often measure our progress against our neighbors or social media influencers, which is a game you can never win. Social media is a highlight reel. You're comparing your behind-the-scenes footage to everyone else's best of montage. It's not a fair comparison, and it's mathematically flawed. Let's look at a case study. The tale of 2 savers. Meet person A and person B both earn the same salary. Person A buys the latest car on credit. Person B buys a reliable used car and invests the difference. 10 years later, person A is still paying off the interest on that car, which is depreciated by 60%. Person B has a portfolio that has doubled in value, generating its own income. This is the wealth gap in action. It isn't always about who makes more. It's about who keeps more and puts it to work. Wealth is a product of time, not just income. Another major mistake? Ignoring the hidden cost of living. This includes taxes, maintenance, insurance, and the opportunity cost of your money. When you buy a house or a car, you aren't just paying the sticker price. You are committing to a lifestyle cost that persists for years. This is why the rule of 72 is so powerful. It's a simple way to see how long it takes to double your money based on your annual return. If you can get an 8% return, your money doubles in 9 years. If you don't invest, that same money sits still, losing value to inflation every day. It's not magic, it's just math and patience. But our brains fight against this because we want results now. This is why loss aversion is a real thing. We feel the pain of losing $100 twice as much as the joy of gaining $100. Because of this, we often sell at the wrong time. When the market dips, we panic because the pain of seeing our balance drop feels like a physical threat. To master this, you need a financial plan that is written down. When you feel the panic, you don't rely on your emotions. You look at your plan. Your plan should include your goals, your risk tolerance, and your emergency fund. It's your compass in a storm. Diversification is another crucial rule. Never put all your eggs in one basket. If one sector crashes, your entire life shouldn't fall apart. By spreading your risk, you smooth out the ride. You might not get rich overnight, but you also won't go broke overnight. Think about your financial season. Are you early in your career? You can afford more risk. Are you approaching retirement? You need more stability. Adjust your strategy, but don't abandon your principles. The best investors are boring. They don't chase the newest crypto trend or the hottest stock tip. Finally, remember to celebrate the small wins. Every dollar invested, every debt paid, every month of consistent saving is a victory. You have the tools. You have the psychology. Now, you just need to start. The best time to start was yesterday. The second best time is today. Thank you for joining me on this deep dive into the psychology of money. If this helped you gain clarity, share it with someone who needs to hear it. Stay smart, stay patient, and I'll see you in the next one.